Good morning. Welcome to Market Monday. You may have heard last week a credit ratings agency called Fitch downgraded the credit rating of the United States from AAA to AA+. Credit ratings play a huge role in the global financial system. They determine a company's borrowing costs and can help in determining how risky a company or country's bonds are from an investment standpoint. But just like Chad's been talking about for the past few weeks, we also need to take credit ratings with a grain of salt. If you remember, this wasn't the first time the United States credit rating was downgraded. The last and only other time was in, you guessed it, August of 2011 by another major ratings agency. And we know what happened in markets and the economy over the next 12 years. So there is no reason to be alarmed. Not convinced? Have a look at this. Here's the same rating agency evaluating Microsoft's credit rating. That's right, AAA, higher than the United States of America. They do know that the United States literally creates dollars, don't they? To be fair, this Microsoft rating is from January of this year, and as you see here, Fitch subsequently withdrew its rating, probably due to Microsoft no longer paying Fitch for the rating service. Still not convinced? Here's Lehman Brothers in 2008 with a AA- rating for both its long and short-term rating. Of course, it was only a few months later when Lehman went bankrupt. Grain of salt. What else? Since we recently flipped the calendar, let's check in on the seasonality of markets. We've talked about seasonality a lot on Market Mondays over the years. We like to think of seasonality like climate, not weather. First, we can see in gold here, which is all years since 1950, the first half of the year tends to be pretty good. Check. Then, basically starting now, we're entering into a seasonally tough period, then only to rebound for the remainder of the year. The same, more or less, holds true for the past 20 years here in blue. Same with the past 10 years here in green. But look at that. In black, we have just the pre-election years like we're in this year. Really strong first half, check. August still up, but much less so than down in September. Then ever so slightly up through October and November, with a strong finish to the year. Here's a different look at the same concept. The dark blue line here is the same as the black bars from the prior slide, pre-election year since 1950. Strong first half of the year, then we take a breather for a couple of months through November, only to see that final push in December. And of course, in red is the S&P 500 stock market so far this year. Climate, not weather, but tracking quite closely. That's why so many folks are calling for a pullback, or a pause at the very least, in the months ahead. So we're just going to repeat today's episode of Market Monday every week until we get through the November period. No? I can already feel the tomatoes being thrown at the screen. Not to worry, we'll have new videos every week, but after today, there are 16 Market Mondays till we get through November. And we're making no promises about how many times we'll revisit this seasonality. Why? As soon as we get a 5 or 10% pullback, the noise is going to amplify. The headlines are going to bombard us. The lag from the rate hikes is finally going to take place. The recession everyone's been calling for the past 18 months will finally have arrived. So expect it. It's coming, and we'll be here week in, week out to walk you through it. Speaking of recessions, you know that group that are the official arbiters of recessions in the US, the NBER, National Bureau of Economic Research? They use a composite or a group of variables to make recession calls. This isn't a research firm or a fund company. It's the group that determines recessions. Perhaps we should pay attention. Naturally, when their recession index goes higher, usually that coincides with recession. Make sense? Does to me. Oh, here's COVID. Not quite as high, probably because it was just so quick. And here's where we are now. You're seeing that right, heading lower. And if that's the case, it would seem we just went through a textbook non-recessionary bear market. Including last year, there have been 11 of them since 1928. Here's last year down here, almost a perfectly average non-recessionary bear market, both in terms of drawdown and number of days till the bottom. Thanks for watching. Have a great week.